Module, Single Obligor Limit and Sectoral Lending Limits, NRB Directive. In this session, you will learn what Single Obligor Limit means. We will cover fund-based and non-fund-based exposure ceilings and sector-specific enhanced exposure limits. You will also learn about hydropower and infrastructure lending provisions and related borrower grouping rules. Finally, we will discuss reporting and compliance requirements mandatory under the Nepal Rashtra Bank regulatory framework. Single obligor limit refers to the maximum exposure allowed by a bank or financial institution to one borrower or group of related borrowers. Exposure includes fund-based facilities, non-fund-based facilities, and guarantees. It also covers commitments, letters of credit, and other contingent liabilities. This limit ensures that institutions do not concentrate excessive credit risk in a single borrower. As per NRB directive, a bank may provide total exposure to a single borrower group up to 25% of its core capital. This includes both fund-based and non-fund-based exposure combined together. This is the standard single obligor limit applicable across sectors unless special provisions apply. Higher exposure is permitted for selected productive sectors, for sectors such as agriculture, tourism, energy, cement, iron and steel. Also included are small and medium industries, export-oriented industries and infrastructure projects. For these priority sectors, the exposure ceiling increases to 30% of core capital. However, this applies only when lending is directed toward productive economic activity as defined by NRB. Special regulatory flexibility exists for hydropower and energy infrastructure projects. BFIs may extend exposure up to 50% of core capital for hydropower and renewable energy projects. This also applies to transmission lines and cable car infrastructure projects. However, if lending exceeds 25% of core capital, a power purchase agreement must be in place. Repayment schedules for energy infrastructure must be prepared based on verified project cash flow and feasibility projections. Loan repayment should normally begin within 3 months after electricity generation starts and grid connection is completed. If exposure exceeds the prescribed regulatory ceiling, the excess portion is treated as a regulatory violation. Additionally, loan loss provisioning must be maintained at 100% on the excess exposure amount. Certain exposures are excluded from the single obligor limit calculation. These include facilities backed by Government of Nepal securities or Nepal Rashtra Bank instruments. Also exempt are multilateral development banks and internationally rated banks providing guarantees. Multiple borrowers are treated as a single exposure group if relationships exist through ownership, management, or control. This definition also includes linkages through guarantees, family connections, or shareholding structures. For example, if one company holds 25% or more shares in another, both are treated as a single group. Related individuals include spouses, parents, and children when a financial linkage exists. It also extends to brothers, sisters, and other dependent family members. BFIs must maintain updated records of single borrowers and related borrower groups. These details must be submitted periodically to the Nepal Rashtra Bank Supervisory Department. Loans exceeding specific threshold levels must be reported on a quarterly basis. For Class A institutions, the reporting threshold is exposure above 50 million rupees. For Class B and C institutions, the threshold is exposure above 20 million rupees. Reports must include borrower details, group exposure, and a breakdown of both fund and non-fund exposure. Banks must monitor sector-wise exposure concentration continuously to control risk. If exposure becomes excessive, internal monitoring systems must trigger corrective action or additional provisioning. Total exposure toward the real estate sector must not exceed 25% of the total loan portfolio. Within this, land purchase and plotting loans are capped at 10% of the total loan portfolio. For residential housing loans, the standard loan-to-value ratio is capped at 50%. For approved housing company projects, the LTV limit increases up to 70%. First-time home buyers for properties up to 30 million rupees can access up to 80% LTV. For personal vehicle loans, the maximum loan-to-value ratio allowed is 60%. This standard 60% limit applies to both personal and electric vehicles. However, replacement of vehicles damaged by disasters may allow up to 80% LTV under specific conditions. In summary, the standard SOL is 25% of core capital, increasing to 30% for priority sectors and 50% for hydropower. Real estate is capped at 25% of the portfolio, while LTVs range from 50 to 80%. Compliance with these limits is mandatory for maintaining regulatory discipline and controlling risk in the banking system.